While the rest of retail is practically bleeding out from theft, Dollar Tree just reported expanded margins and a 38% jump in profit. Welcome to Earnings Unscripted. It is May 28th, 2026, and we are digging into Dollar Tree's Q1 results. Ticker is DLTR. And honestly, it turns out there is a ridiculous amount of money to be made by breaking the $1 rule.
They added 630 multi-price stores in just 3 months. So yeah, that scale completely changes the math. You get EPS at $1.74, which frankly blew past expectations, and operating margins hit 9.5%. That's up a full 120 basis points. In this kind of macro environment, that is a serious anomaly.
It really is. Though, quick pause, just a reminder, we are basically two friends thinking out loud on microphones, so please do your own research. This is definitely not financial advice. But okay, the top line hit $5 billion flat, up 7.2% year over year. What actually stood out to you under the hood?
The spread between traffic and ticket. Comparable store sales grew 3.5% overall, but that is entirely carried by a 4.5% surge in average ticket size. The actual foot traffic it declined 1%. So fewer people are coming in. They're just spending significantly more when they do.
Which management seems entirely fine with. I really love the CEO's analogy for this. Mike Creedon basically said if you swap 4 of those cheap little $1.25 items for one $5 hardware hammer, your overall unit value completely tanks, but your profit per square foot just violently increases. The Shof works harder.
Precisely. And Wall Street clearly loved that logic today. If you look at the tape, the stock spent the entire quarter sliding in this miserable, choppy downtrend. It dropped nearly 20% leading up to the print.
Just a total sentiment washout.
Exactly. Then earnings dropped this morning, and the pre-market absolutely spikes right into the 8 a.m. call. It gapped up at the open and eventually closed the regular session up 18%. At $113. They basically reversed a full quarter of pessimism in 6 hours.
And apparently proved they are immune to random supply chain shocks. Creedon casually mentioned he bought Dollar Tree stick balloons for his son's 15th birthday because there is a global helium shortage. It is such a funny little flex. Like macro supply chains are a mess, but we have plastic sticks and $1 billion in cash.
Well, the cash pile is actually the most interesting part. Now that they have finally cut Family Dollar loose, we really need to look at what they're doing with the balance sheet. It is heavily mutated from last year.
Oh, right. Let's get into the details on that, because the capital allocation story right now is wild.
Right, the balance sheet. So without Family Dollar dragging them down, they are sitting on a massive pile of cash. $1.007 billion, to be exact. That is up 40% sequentially. And they did not just sit on it. They torched $595 million in a single quarter buying back stock.
Wow. That is, 5.5 million shares just gone?
Exactly, 5.5. So when you look at that 38% jump in earnings per share, sure, operations improved, but a huge chunk of that EPS beat is pure financial engineering. They shrank the denominator.
Okay, fair. I mean, if I had $1 billion lying around after a massive corporate divorce, I would probably treat myself too. But what is really funny is they are still getting paid by their ex, the TSA income?
Right, the Transition Services Agreement. It is a brilliant little cash flow loop. They spun off Family Dollar, took that brutal write-down last year, and now they charge the new separate entity for shared IT and supply chain support. They booked $21 million in net income just for providing those services in Q1.
That is wild. They're literally getting paid to help their ex move out.
Pretty much. But look, a clean balance sheet is great, but their forward guidance has this massive structural blind spot right now, and it is entirely out of their control.
Are you talking about this Supreme Court ruling?
Yeah, the February ruling, the one that invalidated those IEEPA trade tariffs. So right now, the U.S. is leaning on temporary 10% global tariffs under a 1974 Trade Act, and that temporary fix expires in July.
So if you are Dollar Tree and you import a huge percentage of your inventory, how do you even model the back half of the year?
Well, you guess conservatively. Listen to what CFO Stuart Glendinning said on the call. He stated, quote, "We are assuming that the current tariff rates remain in place through July
and then increase in the back half of the year to the levels predating the February decision. And he specifically noted they have not included any potential tariff refunds in the outlook.
Okay, so they are modeling for the worst, assuming costs spike right before the holiday season, but ignoring the potential windfall if they actually get refunded for those past unlawful tariffs.
Exactly. It introduces this extreme unpredictability. If the refunds happen, it is a huge cash injection. But if permanent higher global rates get locked in post-July, their cost of goods sold skyrockets right when they're stocking up for Q4.
Geez. Okay, but internally, they are at least controlling what they can, right? Because earlier we mentioned the shrink issue. That was another wild detail in the report. They actually lowered shrink.
Yeah, and that defies almost every macro retail trend right now. Gross margins widened not just because of higher mark-on prices, but because they physically lost less inventory. They implemented these non-negotiable store audits. They called them the GOLD standards.
Grand Opening Look Daily. And the CDO, Mike Creedon, was really specific about this. He said, while it is still early days, we are starting to bend the curve on shrink. Performance is holding up better and losses are coming down. So locking up the high-value items and policing the floor is actually working.
It is working. But it's sort of a zero-sum game with costs. They plugged the theft hole, but their SG&A costs still ticked up 50 basis points. And a big driver of that was elevated general liability claims, people slipping in stores, or just higher legal and self-insurance costs.
So you fix the inventory theft, but you end up paying out more in customer litigation. Retail really is just an endless game of whack-a-mole. So with all of this moving under the surface, where does that actually leave their trajectory heading into next quarter?
It leaves them in a strangely comfortable position, actually. Management bumped up their full-year earnings outlook to, I think it is a range of $6.70 to $7.10 a share.
So wait, they raised the full year with all that tariff uncertainty still hanging over the back half? That seems pretty bold.
Well, yes, but look at how they engineered the math. They raised the EPS target largely because of those massive share repurchases we talked about. The denominator is just smaller now. They actually took a highly conservative macro view for the operations. They are assuming fuel costs stay high all year, and they specifically excluded any potential windfall from the tariff refunds.
Okay, so if the government actually pays them back for those unlawful tariffs, it is just pure upside for the balance sheet.
Exactly right. The CFO, Glendinning, basically stated they are not baking in any refund benefits just given the sheer uncertainty of the timeline. They are modeling for the heavier pre-ruling tariffs to snap back in July. So if the macro environment gets worse, they are prepared. If it gets better, they look like absolute geniuses.
The ultimate corporate hedge. But stepping back for a second, I kind of really respect what they pulled off this quarter. Breaking the $1 barrier was terrifying for their brand identity, but they pushed through that initial price shock, and now they expect foot traffic to finally start normalizing.
Yeah, and they clearly know they have a captive audience right now. Glendinning pointed out that in this kind of macro environment, Dollar Tree becomes a crucial partner for stretched consumers. I believe his exact phrase was that shopping there is, quote, guilt-free treat yourselves.
Guilt-free treat yourselves. I guess buying name brand hot sauce or a $5 hammer is definitely cheaper than retail therapy anywhere else.
It is. They ripped off the Family Dollar Band-Aid, plugged the inventory theft, and completely leaned into margin growth. The operational turnaround is legitimately impressive.
A surprisingly optimistic note from you to wrap on. I think that's a perfect place to leave it for today. If you'd like these earnings breakdowns to just show up automatically for you, following the podcast is definitely the easiest way to do it. And as a quick aside, we are an AI-generated show, which is how we're able to parse through all those dense corporate filings and build these conversational voices so quickly. If there's a specific ticker you want us to look at next, just shoot a note to earningsunscripted@datamadness.ca or grab the X link right in the show notes. Thanks for listening, and catch you next time.
See you out there.